Good morning, everyone. Thanks so much for joining us. Thank you to all our customers, partners, everybody who's come to join, even some competitors I'm sure who are out there. Today's a very exciting day. Inoxico is launching Trade Shield. Okay, some of you might be having some deja vu. We did launch a version of Trade Shield, a very initial version in September last year. And what we've done in the last 9 months or so since then is work very closely with customers. We spent a huge amount of time with them, refining that initial product, but also bringing into it our entire suite of innovative products that are all focused around trade credit. So today is a really exciting day for us. We're really looking forward to showing you what we've done and what we've got. We are going to be disrupting and transforming the industry of trade credit risk management, and today is about showing you where that's going. So I'm going to be doing the initial presentation of Inoxico, who we are. But the other presenters today, we're very fortunate to have Nikki Weimar, who's the chief economist at Nedbank. She's going to be presenting to us what's going on in the local and global economy. And then Ian Logan, our chief revenue officer, will take over, and he will actually do the presentation on Trade Shield. What is it about? What's it going to do for you? And how it's going to transform your trade credit operations. So if I may start, those of you who don't know Inoxico so well just yet, who is Inoxico? What are we about? Why are we different? Inoxico is a technology company primarily. We produce technology, but we are focused on a very specific niche. And that niche is trade credit. And we provide the analytics that our customers need in order to make really good decisions. So our customers are the types of businesses who are dealing with other companies. They are on other businesses. They are selling them products and services on credit. Right, and many of them have to make really good decisions. But we're really passionate about trade credit because we see those credit managers and CFOs who extend trade credit essentially as providing very important working capital to their customers. If companies in an economy like South Africa's did not get access to that kind of trade credit, they would have to get it from other institutions, banks, etc. And for many companies, that would be too expensive, too difficult. So trade credit is an essential form of growth capital in markets like South Africa. And essentially, our customers who then give that credit are like lending institutions in some sense, and they are trying to make a return on their investment into those customers. And we are involved in that process of making sure that our customers give more credit to good companies so that they can grow and reduce also the exposure to companies that would cost them. So at the end of the day, we are there to ignite this profitable growth in the economy through trade credit. What is also different about us is although we're a technology business, we are very centric and customer centric. We're focused on these businesses who extend trade credit to other companies. Right? We spend over 100 hours since our last launch with customers to understand their problem, right? To really go deep, to really figure out what is it that is causing them these issues, and what is it that they want, and how can we help them to grow their businesses faster. And here's an overview. We essentially are doing this in Trade Shield in 4 steps. We're going to go into this in a lot more detail in this presentation. But what we've managed to do is build a very powerful system that can automatically collect and aggregate data into one place to build a single view of a customer. We are then able to build very powerful and predictive analytics on top of that. That was essentially where we were at last year. We were able to build very powerful models that can predict future risk. Right? So is a customer of yours going to pay well, or are they likely to pay poorly? But what we learned from our customers in these sessions, and was very important for us, is that they want us to go the next step. And the next level is to actually make recommendations based upon all the data we collected, all the analytics on top of that. We need to make good recommendations. We need to tell our customers, and we need to help them set the right credit limits for new customers and existing customers, and continuously. And that doesn't happen unless you've got that 4th step, which is the automation of these processes. So this is what our technology is really about, and we're going to go into today. And it is really disrupting this market. This is really quite revolutionary. We've taken a huge step here, and we're very proud of the capabilities that we're able to do here. So what does it mean for our customers? They're able to now to grow their revenue faster whilst reducing bad debts, improving their DSOs and working capital efficiency, as well as improving the entire efficiency of their credit management function. And that means credit management can now become a supporter of profit-driven growth within our clients. Briefly, just more about Inoxico. We do have some very powerful partners. We have Moody's Analytics, who has provided us with their financial statement analysis tools. It's integrated into our systems. They've chosen us as a partner for this market. So we're very proud of that. Equally, Dun & Bradstreet, very big global name in business credit reports, is using us for sourcing information from certain African countries. And Marsh is a global insurance broker. In South Africa, we're working with them and their clients who are credit insured businesses to help them better mitigate and manage their risk and also increase their profits. So these are international brands who have decided to work with Inoxico. So we're very proud of these, and it validates that we are on the right track and doing a great job. We also have a very good local partner, Prestige Advantage, who has a very specific niche within the market, very good, also trade credit insurance broker, and we're working with them. And we will continue to expand our partnerships over time. Inoxico today has over 350 clients. We focus on large businesses. This is just an overview of some of them. They range from international conglomerates to local large conglomerates, group businesses to single companies in all sectors. So we're not very specific in that regard, but only that typically our clients are very large businesses with a lot of credit exposure to other businesses. And so what we're going to be doing is showing you later is some of the impacts that we've already had for some of these clients so that you can see the kind of impact that we could make for your business. So my task now is to introduce Nikki Weimar. Nikki Weimar is Nedbank's chief economist and has been for many years there. Previously, she advised the government on economic procedures and policies. Her experience is very broad. She's got experience in banking, securities, brokering industries, and very specifically also around the relationship between real economic trends and developments within financial markets. At Nedbank, she focuses on trends in the overall economy, looking at cycles in the economic growth, inflation, and interest rates. That is certainly very topical for us today. She's a renowned speaker, and we look forward to her insights on the local and global economy. Our audience today, if you're CFOs and credit managers and credit controllers, your job is to protect your business from risk. So Nikki's insights on the volatility ahead is going to be very important to help us all understand what's coming and be able to protect ourselves and mitigate against those risks, but also to understand where there are opportunities, because it's those who are able to navigate these stormy times that are going to be successful going forward. So thank you very much. I'm going to be handing over to Nikki in a moment.
Good morning, ladies and gentlemen. As has been said, my name is Nikki Weimar. I'm a chief economist at Nedbank. And my aim today is to do what we always do, and that is to give you a quick economic update. In other words, a sense of where this economy is at the moment, and then hopefully some insight into what to expect in the years ahead. So without wasting any further time, let's get going. So where is South Africa at the moment? Well, the good news is we are in the process of recovering from the real shock that was level 5 lockdown in 2020. This graph really reflects that. It shows you in red there South Africa's GDP, that is the rand value of our GDP, the absolute size of the economy, after we've adjusted for the effects of inflation. And then the green bar shows you the year-on-year growth rate on a quarterly basis. And you can see that South Africa is in the process of recovery. We have regained a lot of lost ground. We are not back to pre-pandemic levels. So in reality, it has been probably not the smoothest recovery out there. It has also not been the most convincing among emerging markets, but we are very close to pre-pandemic levels. If this year occurs in a normal fashion and we see a return to economic activity and the normalization of trading conditions, we should probably return to pre-pandemic levels and maybe even exceed pre-pandemic levels a little bit by the end of this year. Now, the reason our recovery has not been smooth sailing is because it's been very stop-start in nature, and every little weak spell that we encountered have, of course, been associated either with another COVID wave, with stricter lockdowns. Let's not forget, throughout the past 2 years, we've had to deal with persistent seemingly never-ending power outages as a result of load shedding. We're still contending with that. It's still going to be a feature of our recovery going forward. And at the same time, over the past 2 years, we've had other shocks to absorb, shocks that many other emerging markets did not have to contend with. Among others, the cyber attack on Transnet's ports that resulted in a delay in the processing of cargo, affected our exports and our imports. Many manufacturers, many miners were affected by that. At the same time, also, we've of course had the devastation left by July's riots. And then finally, right now, we've got more shocks to contend with. We're now going to have to deal with the destruction caused by the floods in KwaZulu-Natal and parts of the Eastern Cape. So it's been a very difficult 2 years, but the reality is, if you look at that graph, we've been slowly crawling our way back to firmer ground. Now, what's brought about the recovery we've seen so far? Now, in any given economy, if you look at that little pie chart there, you've essentially got 4 sources of demand, right? You've got consumer spending, you've got fixed investment. What is fixed investment in economic terms? Fixed investment is not investment in shares and stocks and bonds. It is essentially when companies go out there, feel positive enough about future prospects, about future growth prospects, to take the risk, go out there, borrow the money and expand their operations. So fixed investment is the good type of spending. That's what leads to a situation where you have more productive capacity in the economy, companies will produce more goods and services in the future, and it is also the key to job creation. So that's another source of demand. Then, of course, there's government consumption expenditure. Government can extend its spending, and that could support or be a source of demand in your recovery. And then the final one is something we call net exports. It's simply exports minus imports. Now, if you've got a positive export balance, in other words, your exports exceed your imports, that adds to your economy. If you've got a negative balance, that is a drag on your economy. And in any given economy, these are your 4 sources of demand. If you're growing at that point in time, it's come from one of those 4 sources. If you are shrinking at that point in time, the drag is coming from one of those 4 sources, or from all of them, if it's a synchronized downswing. So the reality is, that is where the growth is going to come from. So now we're going to see which one of those 4 sources really brought about the recovery we've experienced so far in South Africa. And that other little chart, the line chart, shows you where that growth is coming from. What we're doing here is we're taking all of those sources of demand, we're indexing them to 100 just before we entered level 5 lockdown. You can see the devastation caused by level 5 lockdown, and then you can see how, as we started easing lockdown restrictions, economic activity started to recover, and we started to rebound. But you can see that the real lift came from consumer spending and it came from net exports, right? So that's where the boost came from. That's what brought about the recovery. Now, that is really where we are at the moment. We're in the process of the recovery. It's not been the most convincing recovery out there. It's been very stop-start. We've had to endure many shocks, but it's really a rebound in consumer spending and a resurgence in net exports that made the difference for South Africa. So that's where we are at the moment. So the question now is, where do we go from here? So what we're going to do now is we're going to see which of these sources of demand will provide South Africa with some lift in the years to come. And we're going to start with net exports and consumer spending. These have been the 2 powerful drivers of the economic recovery we've seen so far. So let's see how they are likely to play out in the years ahead. Now, the boost provided by net exports was significant. It was enormous. In fact, so much so that we ran a trade surplus of 7.5% of GDP. So that's how much it added to our economy. It was so large, this trade surplus, that it helped to bring about a current account surplus. For last year, the current account surplus averaged just over 3% of GDP. So the question now is, will it last? So we know exports outpaced imports by a wide margin to the extent of 7.5% of GDP. But the question is, will it last? Now, there are 2 elements to net exports, right? Yes, you're looking at exports relative to imports. That's essentially what you're doing. And there are 2 elements there. There's a volume element and there's a price effect. So we're looking at export volumes relative to export import volumes, sorry, and we're looking at export prices relative to import prices. And this graph shows you on the one side the volume effect and on the other side the price effect. Now if you look at that first little chart, you can see that both export and import volumes recovered, and export volumes did a little bit better than import volumes, and that contributed to the trade surplus, that contributed to the net, to the positive net exports that we saw. However, that's not where the real boost came from. The boost came from the price effect. Export prices surged away from import prices. And it is that provided such a strong boost to our recovery and also made all the difference to government, because they saw a resurgence in corporate profits, really as a result of the return of very strong profits in the mining industry, which all reflected this resurgence in export prices. Now, the bulk of our exports are commodity-based. In fact, our biggest exports are gold, platinum, iron ore, and of course also coal. Not so popular these days anymore, but it is still a major contributor to South Africa's exports. So it's commodity prices, the resurgence in commodity prices, that provided the oomph to this economy. So again, we come to the question, what's going to happen to export volumes? What's going to happen to export prices relative to import volumes and import prices going forward? Of course, the world's changed. All right. What happens to our trade account, what happens to our exports and our imports are a function really of what happens to the global economy and what happens to commodity prices. And these two are intrinsically linked. If the world economy is growing, then there's more demand for commodities and commodity prices tend to rise. If the world economy is slowing or shrinking, there's less demand for commodities and commodity prices tend to come under pressure. Now, the world has changed significantly. The global economy rebounded very strongly from the hard lockdown in 2020. It was the result of enormous monetary stimulus, of enormous fiscal stimulus, and it also was the result of a resurgence in the demand for goods. And all of that helped to bring about this very nice rally we've seen in commodity prices. But now the world is changing, and it is changing very rapidly. First off, the pandemic, the resurgence in the demand for goods really overwhelmed the global economy's ability to meet that demand. And so even during the course of last year, we saw the buildup of inflationary pressure. And as inflation started mounting all over the world, you also saw that central banks, and especially the big central banks, started to look at the situation and realized that they needed to withdraw that pandemic stimulus. They needed to tighten financial conditions, and they essentially needed to start normalizing their monetary policy. So that was already starting to put pressure on the world economy, rising inflation, which erodes households' purchasing power, and also the normalization of monetary policy that was gradually and very slowly occurring. And then, of course, we came into this year, and Russia decided to invade Ukraine, totally unprovoked, absolutely tragic, but of course that has changed the world completely. Now, Russia's war in Ukraine will have very significant consequences. In its essence, it's a commodity price shock. Of course, Russia plays an outsized role in the global commodity markets. They account for 12% of global oil production. They account for an even bigger share of natural gas, 18% of natural gas production. So they play this outside role in global oil and gas markets, and as a result of that, that have had a very significant impact on prices. So the moment the war started, the moment the West and many other countries imposed economic sanctions on Russia, placed pressure on their exports to the rest of the world, they also, of course, drove up global oil and gas prices. This is Brent crude oil price. You can see it's miles above the average of recent years, trading over $100 a barrel. At times, it has sort of eased a little bit. We've seen it dip a little bit below $100 a barrel to around $99, $98 a barrel, but generally speaking, it appears to be holding at very high levels. So this is going to add to global inflationary pressure. Sadly, Russia and Ukraine combined also play a significant role in global food production. You can see there, I show you, they're very big in wheat. Russia and Ukraine combined produce 30% of the world's wheat, 17% of the world's maize, and very importantly, 50% of the world's sunflower seed, which goes in all the oils we use for cooking purposes and so forth. And so as a result, we've seen this enormous resurgence in food prices. Now, this affects essentials, right? So that's also going to drive up inflation even further. At the same time, there's been some benefit for South Africa. So rising global oil prices, bad for the whole world. Rising global gas prices, bad for the whole world. Rising food prices, bad for the whole world, right? But at the same time, for South Africa, we're one of the few nations that there is also a benefit to. Right? And what is that? The fact that Russia can no longer supply the world with coal means that our producers have an opening. They have an opportunity. Similarly with platinum, similarly with gold. And as a result of that, we've seen that our export prices have actually held up remarkably well. We've seen coal prices soar. We've seen iron ore prices recover again, regain momentum. We've seen platinum holding fairly firmly. It hasn't surged, but it's holding firmly. And we have seen, in fact, gold prices remain very strong indeed. Gold benefiting both from sanctions on Russia and also from the fact that there is inflation in the world economy, and that's seen as a hedge against inflation. So our commodity price is holding up fairly well. But this overall picture is not good for global growth because the surge in oil prices and in food prices are essentially going to drive inflation up even further. This is producer inflation in advanced countries. Look at that resurgence in producer price pressure. It is just absolutely astounding. It happened before Russia invaded Ukraine. Russia's invasion of Ukraine, its impact on the oil and food markets have just made it a lot worse. And increasingly during the course of last year, and now even more rapidly, we are seeing that companies are saying, hang on, we're not going to endure all this price pressure on our own, and they're increasingly passing it on to consumers, right? And as a result, consumer inflation in advanced countries have surged. It's absolutely remarkable. US inflation is now at 8.5%. You have to go back to the early 1980s to get a level like that. So it's it's over a 40-year high. So we are in a very different world, a world where global growth is being threatened by high inflation. And it's not just in advanced countries where producer and consumer inflation has increased very dramatically. In most of your emerging markets, we've already seen inflationary pressure build quite significantly during the course of last year, and now this situation with global oil and food prices is going to make that a lot worse. So what does this mean? It simply means that global monetary policy will have to change, and it will have to change quickly. And that is what we're starting to see. In your advanced countries during the pandemic, they slashed interest rates to near zero. Now they've essentially got to go out there and they've got to reverse this. And we have seen this process starting. Many countries have started to increase interest rates. The UK have increased interest rates 3 times already. The US have had 1 hike in interest rates, but the anticipation, the message the US Federal Reserve is putting out there is they're saying, listen, we're going to be hiking interest rates very, very rapidly. At every meeting for the rest of this year, we're going to be hiking US interest rates. So US interest rates are going to start increasing, and that has implications for all emerging markets. We'll chat about that a little bit later. But in many emerging markets, because the US is now starting to hike interest rates, of course, what does that mean? Your ultimate risk-free nation, which is risk-free investment, which is US treasuries, US money market instruments, they are now offering investors a higher return. Okay, so if you're a risk-averse investor, you're going to leave emerging markets, you're going to take your capital to the United States and other advanced countries which are now offering you a higher return. And that means you're going to have capital outflow out of emerging markets, and that's going to put pressure on their currencies, on their equities, and on their bonds. And in anticipation for this moment where the US would start hiking interest rates, throughout last year, we saw that most emerging markets already started to push their interest rates up so that they can have a bit of a buffer, so that they can offer a bit of a carrot to investors saying, look, we offer you even higher interest rates for the higher risk you're taking. So we've got a situation where across the globe you've got higher interest rates, and it's just going to continue to rise. In the US, we're going to see something else happen, and that is, of course, during the pandemic, the other thing they didn't just cut interest rates, but they also, of course, went out there and they pumped pump liquidity into the system, all right? The so-called quantitative easing. The layman's term for that is the printing of money. And they flooded the system with liquidity. That's essentially what they did. Now, of course, they're going to have to start mopping up that liquidity. So what are you doing when you do that? Well, you're taking liquidity out of the system, you're making financial conditions a lot tighter, but of course, it has implications for currencies. You are taking dollars out of the system. If you take dollars out of the system, there's less of it relative to other currencies, which means that it's got to be stronger relative to other currencies. So that's the other implication. All of this, higher global inflation, higher interest rates, tighter liquidity conditions, all of this means that global growth will probably slow. And the IMF recently brought out their World Economic Outlook yesterday, to be exact, and they revised their growth forecast down to around 3.6% for this year. It was a very significant downward adjustment from over 4%. 3.6% is still global growth, but it's a lot more moderate, it's a lot slower than their previous anticipation. This shows you just GDP in your major advanced countries, and you can see that as we went into the second half of last year, inflation started biting, tighter monetary conditions started biting, and you can see that that upward momentum started to fade a little bit, and more countries started to drift sideways. And that's what we're going to continue to see. And of course, on top of this, you've got China, which is now in the midst of another COVID outbreak, and they have a zero COVID strategy, and so they've put Shanghai, almost 40% of the economy, under strict lockdown. So that's going to have another major impact on global growth and hurt it. So we are looking at a situation where you're going to have slower global growth. That will hurt our export volumes, not help it. And you're going to have higher commodity prices. So what's likely to happen to that trade surplus? What's likely to happen to that 7.5% boost to GDP? That is likely to shrink in the year ahead. So export volumes are going to slow, import volumes are probably going to remain elevated, so the volume effect is going to get smaller. Export prices will hold up, but remember, we are net importers of oil, and that's rising a lot faster. So that gap's also going to close. We still think that net exports will make a positive contribution to the economy, but it's going to be a much smaller positive contribution in 2022. All right, so that doesn't look quite as robust as it did during the course of last year. The journey for net exports is one where it's going to be shrinking, and making a smaller and smaller contribution to our recovery. But of course, the global events also have implications for the consumer. The biggest boost to our recovery, consumer spending is over 60% of GDP. So what's likely to happen there? Well, rising oil and food prices globally will also result in rising local oil and food prices, right? So petrol prices have been going up. Government has mitigated that risk for South Africa by cutting the fuel levy by R1.50 for both April and May, and that's going to make an enormous difference. It's going to take a lot of the pressure out of the system, but they can't protect us against food prices. All right, so that's going to continue rising. So we are probably going to see inflation rise quite sharply. Yesterday, inflation shot up to 5.9%. We think it's going to hover near that level. Remember, it's the Reserve Bank's job to keep inflation between 3 and 6%. South Africa's Reserve Bank, in fact, targets 4.5%, the midpoint of that inflation targeting range, 4.5%. That's where they want to keep South Africa's inflation truly and firmly anchored at that 4.5% level. We're way above it already. And so if you've got inflation above your target level, if you're a central bank, you have to hike interest rates, which is exactly why the Reserve Bank has started to hike interest rates. So inflation, we're going to see that. It's probably going to remain high. If the rand tanks, it can make everything a lot worse. Now, the rand in recent days have come under a bit of pressure again, yesterday especially. I think it depreciated over the day about 3%. But overall, the rand has been remarkably resilient. Really, it's defying logic at this point. You've got a stronger US dollar, which should mean a weaker rand, yet the rand is strengthened. You have got the US starting or getting ready to hike interest rates aggressively. That should hurt the rand. It hasn't done that. You've got the US planning to reduce their balance sheet, to mop up liquidity and take all that stimulus and those dollars out of the system. That should hurt the rand. It hasn't done it. Why has it not happened? It has not happened. We've spoken to a lot of investors because global investors are looking at South Africa and saying, well, they're not Russia, they're not Turkey, they don't have hyperinflation. So South Africa has almost become the best of a bad bunch, right? And as a result of that, we're seeing actually foreigners returning to our bond market, returning to our equity market, and that capital inflow is supporting the currency. Will it last, though? I think it's going to be a very volatile story, because at the end of the day, the rand is a function of what happens to global investors' risk appetite. This graph tries to illustrate that for you. It shows you there our proxy of emerging market risk appetite, which is, of course, that green line, and then the rand against the dollar, which is the yellow line. And you can see how closely they follow each other. At times, the rand trades at a discount to emerging market risk, and at times at a premium. Right now, we're trading at a massive premium to other emerging markets. We've outperformed them by a considerable margin. But ultimately, at the end of the day, if global investors turn risk off, the rand will eventually start to weaken. And maybe we're standing on the precipice of that starting to happen. As the US now starts to pile up those interest rate hikes, as investors reevaluate their options, well, see, I can take no risk and get a higher return. You are probably going to see the rand become more volatile. You are probably going to see the rand come under some pressure. And so as a result, we do think the rand will weaken. Will it fall through the floor, April 2020 style? Probably not. Okay, so we're going to have a weaker rand, but it's going to hold up relatively well. It's not going to add enormously to inflation. But with inflation running over 4.5%, the Reserve Bank will continue to hike interest rates. They will also hike interest rates for the same reason other emerging markets have hiked interest rates, to build in that little buffer, to give that little carrot to investors and say, come, you can get an even higher return. Yes, you take more risk, but you get a higher return. And they're going to keep doing that. So we do think they'll continue to hike interest rates. At the end of the year, interest rates will probably hike at every meeting for the rest of this year. At the end of the year, we see interest rates at 8.75. Then we see another 50 basis point hike next year, taking interest rates to 9.25. We think it will be steady there for quite a while before it will go up by another 50 basis points. Yet, even by the time we get to the end of 2025, you'll see that interest rates will just return to pre-pandemic levels. So it's not going to be enormous pressure, but it is going to weigh on consumers. So higher inflation and higher interest rates, the systematic increase in interest rates will start to weigh on consumers in South Africa. It could affect their confidence. It could affect their conviction to go out there and spend and add to economic growth. But at the end of the day, the biggest contributor to consumer spending is household income. Now here I show you in green household income, personal disposable income, and I show you also consumer spending. And you can see income is the biggest driver of spending, unsurprisingly. And income has recovered very convincingly. And you might say to me, but Nikki, how is that possible? How is income almost back to pre-pandemic levels when we read in the newspaper and see on the news all the time that unemployment just continues to rise? And indeed, that's true. Our unemployment are now at record highs, unbelievable, some of the highest in the world. We've got now discouraged workers, people that have been unemployed for so long, approaching 3 million people. It's just inconceivable. And despite that, household income has recovered. How has that happened? Because the boost came from wages and from other incomes, which is rent, profits, and so forth. So as the economy opened up, as lockdown restrictions were eased, more businesses could operate normally. Some of them are one-man concerns, some of them are small businesses. So company profits recovered, working hours recovered, people were paid more, and so pay, bonuses, remuneration, and other sources of income, profits and rents and so forth, all they did the heavy lifting behind the recovery in household income. And we believe that will continue. Wages are settling at higher levels. Companies are trying to retain their staff. In other words, they are paying better bonuses. And at the same time, of course, we are seeing the normalization of our working environment. If we have another wave of COVID, it could be a source of disruption, but we think it's highly unlikely that lockdown restrictions in 2022 will be anything as severe as we saw in 2020 and 2021. And so therefore, that will also provide your labor-intensive industries, which is really hospitality, hotels, accommodation, tourism, travel. That will provide them with the space to recover. And as they recover, some jobs will be created in the process. All right, so the consumer is going to be a driver of growth despite higher inflation, despite higher interest rates in our view. That leaves only fixed investment. Can that make a contribution? The good news is that we are seeing some life in fixed investment. Of course, that's the breakdown of fixed investment there. You can see where the drag came from. The drag really came from that implosion in fixed investment by state-owned enterprises, which is your Escoms, your Transnets, and so forth. So they were a big drag. But you can also see the red line, which is private sector fixed investment, is starting to recover. So fixed investment will also contribute. It won't make an enormous contribution, ladies and gentlemen, because we are still dealing with load shedding. As we speak today, we're in stage 3 load shedding. So as long as we've got power issues, we're not going to see a massive resurgence in fixed investment, regardless of what government might say. It's just not going to happen. We have to resolve our energy problems if we want to see fixed investment drive growth. So to wrap it up, what can we expect for the year ahead? We're probably going to have slower growth. We're anticipating 1.9% growth this year, 1.7% next year, and 1.3% the year thereafter. The consumer is going to do much of the heavy lifting this year, with a little bit of help from higher fixed investment. But overall, our net export position will probably come under pressure. Generally speaking, it's a modest growth picture. If we want to get higher growth numbers, it's not impossible, but then we absolutely have to resolve our energy crisis. I hope it gives you some indication of where we're heading and what to expect in the years ahead. Thank you.
Great. Thank you, Nikki, for your insights. Incredibly entertaining. Just an incredible presentation. A few green shoots there, but a concern for the economy. So carrying on with the presentation around Trade Shield, Dom referred to the challenges that our clients are facing, the challenges in trade credit. When we've engaged with our clients, there's a couple of needs. They want to make fast, profitable decisions and efficiently manage their debtors book. And that sounds very straightforward, but there are some challenges to that. The data is messy and scattered in different places, there's different databases, there's different feeds of data. It's very difficult to aggregate that data. So it's not that user-friendly. The businesses lack models and technology to predict credit risk. How much money should we extend to a potential customer? And this causes the friction between the sales division and the credit division. The sales want to sell, they want to extend credit. The credit division are often more conservative. They've got no benchmarks. They don't know how and when to extend credit and the right limits. There's a lack of technology to automate the decision-making process, and all of this means the whole process becomes very resource-intensive and becomes often very subjective as to what limits should be extended. So Trade Shield is a holistic credit risk management solution. As Dom referred to it, and we're going to dig a bit deeper, we collect and aggregate the data, we build predictive payment analytics, we make profitable recommendations, and we automate that process. So when we talk about the data, we collect and aggregate data. If we refer to what is readily available currently in South Africa, and probably for the last 40 years, the traditional data at the bottom there in the blue. We have the CIPC data, a very reliable source of data. We have courts data. We have VAT information. You have adverse listings. you have trade references and bank codes and consumer data. And that's the traditional data that the bureaus and the businesses have been using to predict credit risk. But there's lots of challenges within that data environment. If we look at the court data, often the information that comes out can be 18 months, 2 years after the actual event, so it's very delayed. If we look at adverse listings, well, that's dependent on a business actually listing one of their customers. If we look at trade references are often biased because you give the detail of your best suppliers who you pay on time. There's also challenges with POPIA. Many companies don't want to give a trade reference now using POPIA as the reason. For those who have been using bank codes, you're well aware that only 2 of the major banks provide bank codes, and we're expecting those to fall away probably in 2022, 2023. And obviously the consumer data, very useful if it's a sole proprietor. So that is the traditional view of a credit report and credit data. However, it's fairly limited and not that predictive. So what we are bringing to the party and complementing that data is advanced risk data. This is the top section there. Trade data. We have aggregated from our clients over 600 billion rands worth of trade data on 300,000 companies. And that data means we've got payment data for more than a 6-month period of submissions. We go to our clients and they submit their debtors book on a monthly basis. We aggregate all that data and we use it as part of our development of the models. We don't share the explicit data, we only share the aggregated view and the analytics that come out of it. The financial statement analytics. Dom referred to our partnership with Moody's. They've got a very advanced analytical tool that looks at financial statements and makes very good insights as to whether that business is able to repay their debt. Bank statement analytics. Inoxico developed this in 2021 due to the decline of bank codes. What we have done, we've taken bank codes and enhanced that solution. As you're probably aware, 80% of bank codes were a C code, not very insightful. We provide a lot more information on our bank statement analytics solution, provided we have 3 months of bank statements, and we take the credit application data. So what we do, we aggregate all this data, and it creates billions of data points. So over 12 months of payment data, all the traditional data, all the new data that we combine in there, there's literally billions of data points. We aggregate all of that to create a single view of the customer, which you'll be getting. So when we talk about building predictive analytics, what does it mean? So for every one of your customers, we've got an example here, Jane's Ice Cream. So we analyze their characteristics. We know that Jane's business has had 2 major defaults in the last year, that they are using 93% of their credit limit, not just with you, that's aggregated view across the industry, and that 21% of their industry debt is overview. So now we have a very good view of this business. So we take that data and we align it to all our payment behavior data. And based on trade data profiles that look like Jane's Ice Cream, so very similar businesses, 75% ended up defaulting in the following 6 months. So based on that, Jane's Ice Cream is high risk. Our recommendation at this point would be not to extend credit to Jane's Ice Cream, or if you are currently extending credit, to reduce your credit limits, reduce your exposure. So what our clients need and what they want is profitable recommendations. So we align your strategy to our decision engine. That's the tool that actually makes all the recommendations. We source and aggregate all the latest customer data. We run the predictive payment analytics continually, and we make tailored limit recommendations within your rules. So we align what our output is to your business, what you require. We continuously refine these rules to increase profit. And what that means is that every month we're reworking the tools, reworking the analytics to make sure it is the best solution for your business. So TradeShield will become an integral part of your credit risk lifestyle across credit application, credit risk management, and this is supported by performance and reporting. So I'm just going to take you through an overview of the solution of what TradeShield actually is. We're going to start with the process at the beginning, credit application. So what do we do under the credit application process? First of all, we take your manual credit form and we make it a digital application form. We complement that with our data, with external risk, financial analysis, and payment analytics. and I'll take you through the process now. And out comes an automated credit limit recommendation. So on a new client, rather than guessing what your credit limit should be, we'll recommend that amount to you. However, you don't have to accept our answer. The final decision goes through your current levels of authority to approve it. You can increase it or you can decline it based on what you would like to add to it, if required. The integration is available into major ERP and CRM platforms. So in terms of TradeShield, if we look at the home page, it's very user-friendly. It's been built with our clients, for our clients. There's 3 buttons. Your existing customers on the left, a to-do page, and workflows. And in this case, a workflow, it would be a new application. You click on the new application. You've got the item in the middle there, new customer limit. You click on that, and up comes, and we've used Inoxico as an example. You search for Inoxico, and it will pre-fill the application form with very limited information. We don't need to begin with all those questions that you may have had in your application form, because we can complement it afterwards. What we do, this application form gets sent to your client under your branding. They complete the trade credit limit requirements and the terms, and it will come back into the system, into TradeShield. We complement it with everything we have about that client. And the output is all the information on that client and a credit limit recommendation. If we say it should be limited to 10,000 Rand and not 20,000 Rand, we will give you the reason. We'll say there's judgments there. We'll say the directors are a certain age. It's a risk. All that information is available on application. In terms of existing customers, and this is probably where it gets used the most. You'll have an existing debtor book. It could be a few hundred. It could be a few thousand. And what we're supplying here is a fundamental shift to the business credit risk industry. Is that traditionally, when you wanted a credit information on a business, you would do an inquiry at a credit bureau and you would get a report sent back to you either immediately or an investigative report that could take up to a week, 2 weeks, and cost thousands of rands. What we are doing, we're making all that information available to you 24/7 live. So we call it our Customer 360, and what that is live reports of all our data on all customers, and it's downloadable. So you can click on the button straight away and find out everything about that client, and I'll take you through some of the information now. It's got continuous proactive limit review on all customers. So we've aggregated all this other data, trade data, and we can make a recommendation if that risk is improving, if it's declining, and a recommendation on the credit limit. So you can be hands-on all the time. Effectively, you're applying risk management to each of your customers, but you're also getting a view around customer aging, the trading history, and importantly, for a lot of people who are very comfortable with it, is the traditional data. So how does that look like? Again, you go to your home page, you click on the left there, customers, and up come, you can either search for a customer. In this scenario, it's gone alphabetical. We've got a dummy client here called Excel. Their total outstanding is 8,640 Rand. Their current limit is 10,000 Rand, so they're within their limits, but our recommendation is reduce. So you want to click on that. Now, what comes up, you click through, let's look at the traditional data. Everybody's very comfortable with that in terms of the registered name, in terms of the registration number, date it commenced trading, in terms of the principal details. Everybody's very comfortable with that, and that's what a traditional credit report would look like, and that's very limited information. But we complement that with, first of all here, a recommendation. Our recommendation is to reduce the group limit to 7,500 Rand. What we've done there on the right there, we've got payment behavior, the current and predictive. We believe that this business will be unable to pay the 10,000 Rand limit over the next 3 months, due to all the other data that we are aggregating within the business. So we can make a recommendation to you. And we'll give you detail around that. If you look at this from January, February, March, we see that the default risk or the default score and the payment score is increasing, it's getting worse. So our recommendation, based on all the data we've aggregated, is that this payment risk is actually getting worse, reduce your limit. Likewise, we could have the opposite, where there could be a client that we see the payment risk and default scores improving over time. Our recommendation maybe go from 10,000 to 12,500. It is a live system, and you can draw on the data at any point. We provide a customer 360 trading history, so you can understand here a 3-year view, how this business is trading with yourself. So you get a very good view of the business and all the detail within there. We also provide you there in the middle a to-do link. You click on the to-do link, and what we do there is actions. What actions do you need to be aware of within your debtors book? So if we see a major change and we customize these rules with your business, you may say a judgment of 10,000 Rand or 100,000 Rand isn't important. Anything above that is important. So for example, on this scenario, we've got a judgment here for a company called Exports. You click on Exports, and straight away up comes the judgment information. A new judgment has been recorded on Exports. The company recently received a judgment to the value of 89,000 Rand. This is 86% of their awarded credit limit. Please review your exposure. You can click on the Customer 360 there and get a full view and understand the risk and the exposure of that business and to your business. What does it really mean? So that information is a recommendation that comes through. It could be judgments. It could be a recommendation to increase the limit. It could be all sorts of recommendations that come through a to-do list. And you break this down by credit controller. So they've each got a view, and obviously the leaders would have the aggregated view. In terms of management reporting, we have enabled lots of reports within the system to be used either on a day-to-day basis for a credit controller or for a board report on a monthly basis. This is a view. If we look at that big graph in the middle there, that's how your payment terms are currently sitting. You can break it down by payment risk, credit personnel, business unit or division, debtor name. On the top there, you've got the amounts overdue, the amount over the credit limit, the cost of that funding, hugely important. The cost of funding for trade credit over terms is enormous. Your weighted average days outstanding, balance due, number of customers, it's a consolidated, aggregated view which you can customize so you get a real understanding of your debtors book. So as Don mentioned, we rolled this out. This is kind of the enhanced version. This is some of the feedback we've had since August, September last year from many of our clients. So for example, credit sales increased by 20% and days sales outstanding reduced by 8%, both very positive. For another business, we automated 900 plus credit applications. And what's important there, they weren't just automated through the credit application. 95% were completed in under 30 minutes. Now what that means is you can extend credit immediately to clients rather than waiting 2-3 weeks, getting back incorrect information. The system is there to assist you with that. For another client, we digitalized their credit process and we assisted them with the compliance of their credit insurance policy. There's the automated credit management reporting, which I just shared with you. Another business, 20% growth without hiring additional resources. And another business, we've automated 720 plus instant credit limit decisions. So this is just an example of what the solution can do for you in your environment. So it is there, it's available, a lot of the data is live. So we're coming towards the end of the presentation. And I'd just like to mention, if you do have questions on this, there's a Q&A button sitting at the bottom of your screen. If you would like to ask any questions, Dom and I will review those towards the end of the presentation. So in summary, we partner with our clients, and this is proven to drive real results. Our goal is to assist you in growing sales, reduce bad debt, and improve DSOs. You will win business with faster turnaround time on new credit limits. That's proven. You can proactively extend limits with existing customers and, as importantly, reduce trade with defaulting debtors to limit your exposure. If you understand the risk you're dealing with, you can accelerate your collections, reduce your credit limit, and get the outstanding amounts in more quickly. You create operational efficiencies. Everything will be automated rather than manual processes throughout the business. You reduce legal and settlement costs. If you are reducing your exposure, you can collect earlier. You don't have to go through a legal process. And this whole process, as we've mentioned, is digitized throughout. So the key question here is, that's a lot on offer. Is that how much does it cost? These are monthly subscription fees. It's a subscription basis. We have 3-tiered pricing levels. One is essential, one is professional, and the last is enterprise. If we look at a business that's probably got between naught and maybe 500 debtors, depending on their requirements, we would go for the essential solution. And the key part in there is that you would take the standard Trade Shield solution. And lots of the reporting is still available within there. In terms of professional, you will configure the solution to your requirements, and that would be more for a company between maybe 500 and 2,500 debtors, depending on your requirements. For the larger businesses and businesses with maybe 2,000-3,000 debtors upwards, it is customizable. And depending on your level of customization and your requirements will impact the cost of the solution. So that is the pricing consolidation. We've now finished the major part of the presentation. If there's any Q&A, if people would like some questions, Dom and I will now go through these now. Thank you.
Great, thanks so much, Ian. Thank you, Nikki, as well. We've got quite a few questions coming through, so we're going to see which ones we can get to. Just one of the first questions which was asked was, can we get access to the presentation? Please, if you don't mind, fill out the link that was sent in the chat. That will enable us to then get in touch with you and take the next steps, give you more information, whatever you need in order to be able to take this discussion further. So that was the first question that came through. Ian, one of the questions hasn't been asked just yet, but always comes up is, what has happened to credit reports in our system? Do we still offer credit reports?
Yep, absolutely. We offer credit reports. As we mentioned there during the presentation, the credit reports are available. The credit data is available within Trade Shield. You search for your client or a potential client, and you find that information. What we see is that we will not need to do investigated reports because we have more powerful information with all the trade data we receive. If you look at the investigated reports, often you're asking for a trade reference. I mentioned that they are fairly biased. If you want to pull in a bank code, we already include a more advanced solution with our bank statement analysis. So if you're on a package where you want to take just the data and make manual decisions, the data is available within Trade Shield.
All right. So maybe I'm just going to ask one question from Dora, Dora Marke. How do we assist on sending payment reminders to our clients? We're not offering at the moment a collections tool, but we do have the ability to send out adverse listing, which is a product we've already had, which will now also be included over time through to Trade Shield, which will allow you to, when a customer is significantly overdue, to now send them an adverse listing notice. So it will give them 21 days typically to respond. If they have not paid or responded and you want to continue with the listing, it will then go against their public record. So that is one method that we use. But I think an important distinction I want to make here is that Inoxico is focused on credit risk management, and while sometimes that does play a very important role in collections, you often are going to find you will need additional tools potentially for managing your collections processes, right? So that's all something which we are not very mostly focused on. We're helping you to set the right credit limits so that you never need to be able to send out reminders, although that's probably unlikely in reality. So that was that one question. I got a question here from David. I would like to know more about the predictive payment ability of each debtor. What are the factors taken into consideration in order to compile the predictions?
Okay, so that's quite an analytical question, quite an analytical question. So the real answer should come from our analytics team, who are the who are the people who develop all those models. If you look at it, we aggregate all that data. So a key aspect of there would be the trade data we receive from our clients. And that would be very influential in adding value to the payment risk of that business. And we're able, off that payment data, to understand whether you're going to get paid at the end of the month, which is question number one and a concern for a lot of businesses. But number two, the default risk. Will that business actually go into default and you won't get any money from them? So the data has been aggregated. The data is very predictive, far more predictive than anything that we've had before and the industry has had before. And that model is being continually enhanced. More data we get in, the model is being continually refined.
So to be clear, we're getting a lot of data from, if you are our customer, you're submitting your data to us, a huge amount of the prediction comes from looking back over the past years at how your customers have paid you. Our model responds to that. The payment risk, especially specific to your business, specifically how your customers pay you, that forms an additional layer. On top of, yes, judgments, we do look at obviously other information that is available in SIPC and et cetera. If a company is in liquidation, of course, that will influence the risk. And that will influence, of course, the outcomes. But very important is that we're using far more transactional information around payment experiences that come from you as well as from our other clients. We never share this data between clients. It's a matter of the models themselves understand how your clients pay you and will then help you to predict their payment going forward. So if we want to go into more details, happy to. A lot of that's our specific IP, but we're very happy to give you some more information. So there's been more questions just around more information. Absolutely, please guys, if you don't mind, go to the link that's been sent in the chat. If you can help us to understand where you guys are at, that'll help us to be able to set up more information sessions for you. One question is here, can we get one-on-one training?
Yes, absolutely. So when we engage with a client, we train all your staff, we train the collectors, we train the credit manager. It's a very user-friendly tool, and that's been part of kind of the mandate from our clients, what they need. User-friendly, so whether it's the credit executive wants to use it or the collections clerk, it has to be user-friendly. So we go through training sessions. We obviously have a call center backup service that can take you through any queries on top of that.
Okay, question from Ronnie below at Peter's Papers. How often does the company refresh its assessment of the top risks? I'm not sure if he means, how often do our clients normally do this or how often, but let's answer from the perspective, how often are we reassessing those profiles?
Okay, currently we are receiving data, trade data from our clients on a monthly basis, the majority. We want to move those to a daily basis. Then effectively, you're getting a daily view of how the industry is paying one of your customers. So it is updated every time a new piece of information comes in, whether it's from SIPC, whether it's from judgment data, whether it's from trade payment data, adverse data, whatever comes in, it reruns the model. So it can change hourly, it could change, there may be no change over 2 months.
Okay, related question. So how long does it take to receive a recommended credit limit once a customer has completed the application?
So we send the credit application. You saw the digital application form with limited information. It gets sent to the client. The client has to complete a few brief fields within there. Electronic signature. We would request the 3 months of bank statements because that complements what we're doing. If it's a large limit and you're subject to your credit rules, you would add in the financial statements. Provided that information comes back, it's a 30-minute turnaround time.
So typically maximum 30 minutes, but in many cases, the response will be given sometimes instantly if all the information is available already and we don't need to provide you with additional information. So anywhere between a few seconds and 30 minutes if you're using the entire solution. So thank you, Charlene Bradshaw, that was your question. Interesting question here from Julia, and this is very close to our hearts. I'll read it out. So Julia is saying, every time we mention credit risk, our business partners think we are more about mitigation than revenue growth. How do we sell the solution to our business partners as a revenue growth solution rather than a credit risk mitigation solution?
Okay, if you remember some of those slides I referred to, what are the outputs of Trade Shield? One of the outputs is credit limit recommendations to increase the limit. So our recommendations would be, and if you have a few months of payment risk or payment trends from your client, complemented with the industry payment, and it's paying well, we would recommend you increase the limit. So it is as important to manage the downside, your losses, your exposure, as it is to grow the business. So Trade Shield would enable you to identify clients that you can increase the limit on. And if you look under that to-do section, which I shared with you at the end, it actually has clients in there with manage the judgment, potentially increase a credit limit, etc. So you can be proactive, go into a client, or you can wait for a to-do and then work off there. So you can work with your sales team to effectively say, let's go through your data, your client list, and which clients can we increase the limits on to grow the relationship.
Yeah, very close to our heart. We do see our role is increasing the profitability of your business, right? So we measure actually as one of our key metrics for our customers is trade credit profit. How much additional profit have we generated for you? Not just how much bad debts have we reduced or how we improved the DSOs, but really overall, we want to see our clients grow. And if you're thinking about the challenging circumstances that we're in the market, you need this kind of analytics, you need this predictive capability in order to be able to advise your sales team, to support them, to know where to focus, where to grow. So that I think is a huge advantage of what we're offering and what we're doing. Again, I think quickly back to the credit application process. Charlene Bradshaw was asked, does your system automatically provide feedback to the customer after the company has made their decision? I can answer it just quickly. In our workflow system, it is something you can configure. Typically, clients want to have some interaction on their side. Some of our clients say, no, they will do the interaction through the sales team. But yes, our solution can automatically give you back an answer to your customer so that you don't have to respond to them. Of course, if you're declining the application, you're going to want to be fairly diplomatic about it to make sure that you are able to maybe continue to sell to them on cash. So question here from Polani. How do we calculate the recommended credit limit? Do you factor in affordability and assessment calculation? So Polani, there's a number of steps we go through here. One of them is the calculation of what we would call the maximum acceptable limit. And that's going to have to do with, yes, how much can they both afford? So affordability is one. We look at that, but we also look at their likelihood of their buying capacity to be at that certain level. So we do also not want to push limits to levels which are not ever going to be reached by a customer of yours. So both of those factor into the maximum limit that you would get to. After that assessment is done, then we're looking at how far up to that limit you want to go. And that's really where all the risk analytics come in. Love to give you more information on that. It goes into a fair bit of complexity there. And there's also a fair bit of customizability and rules that depend on your business, your risk appetite as to exactly how you would like to approach all of those. So yes, we do take it into account. It is very important. But it is also going to depend a little bit on your business, how you want to approach it. I got a challenging question from Carl. I'm going to come back to it in a moment, but maybe one for you, Ian. Are customers able to upload documentation required to the system?
Yes, absolutely. So that functionality has been developed. I didn't share with you all the functionality of the entire system, but there is an aspect there where you can upload all the documents relating to that specific customer. It is all available.
Okay, question. We are a steel retailer. Do you have sufficient data in this industry?
So do we have sufficient industry? I think the steel industry, I can't say exactly which clients we have in the steel industry, but what is important, it's not hugely important, because if we didn't have information on that client, we can develop proxies through the analytics to give us a view of that business, even if we've never seen that business before. So if it is a client that we haven't dealt with, we don't have the information on, obviously we have all the CIPC, we have the standard information, but our analytics are able to provide a very accurate recommendation on a business, even though we do not have trade data or huge volumes of trade data on that specific client. So we can still do a recommendation on that client.
No, I can add to that. Look, we know credit guarantee is obviously very strong in the steel industry and has had a lot of historical experience there. We do have a lot of data on companies that buy steel, absolutely. But we're not very strong in the steel industry specifically. But again, to Ian's point, we're very broad. Our clients deal in many cases, they're selling a number of different solutions and a number of different products to companies that are also buying steel. So we have over 300,000 of these data payment profiles. So that is a big proportion of the market already covered. And important is that it's about understanding the behavior of companies that look like your customer. It's impossible for us to have massive amounts of data on every single company and exactly their payment experience. You just cannot get to that point. But what we have are very predictive models. So when we test these models, they are very predictive and very powerful at forecasting the future for companies we have never seen before as well. So when we are doing this modeling, we are separating our data sets into different portions. We'll go into more details, but it's really essentially you train your data on a certain data set and then you test it on companies that you've never seen before, and do you predict their payment behavior well? And in fact, we do. It's very powerful. It's very, very, very strong, and we're finding that it is creating a lot of additional value for clients. So happy to have a POC. A lot of clients, what we do is we sign an NDA, we get your data, we will then do the work on your database and show you what our analytics would do. And a lot of clients at that point then say, fantastic, this does accord with my view, or it's showing me things which I haven't seen before. And that is then the step that you can take. If you are not convinced by our presentation today, we really encourage you, let's do a POC, let's show you, and typically it works out very well. So I think that's the right way to go for that. And it's a similar answer Carl Snyman asked. Also, again, around there's always limited data, perhaps around things like NGOs, and I think you're also mentioning here to some degree, consumer information. Although we do partner with consumer bureaus who do provide us with some of that data, the gaps are always going to be there to some degree. But the important thing is, do your analytics overall perform? Do they provide you with overall profitable recommendations? So we are happy to present to any client how this works. And we've had very, very good results. So if you do not believe our coverage is going to be sufficient for you, put us to the test. Right? That's the easiest way to do it. We're very comfortable and confident, but at the end of the day, the proof is in the pudding. Do you get additional profit out of using our systems? So happy to go and do that for any clients, especially for you, Carl. Would love to come and sit with you and show you what we can do. I'm just trying to go through a couple more here. Don't think we're going to get to all the questions with the time allowed.
May I just make a point? Is that we didn't mention existing clients. We have a vast number of existing clients who do submit their data. All of those clients will be migrated across to the new Trade Shield solution. You have access to everything around the application, around account management, and we will share that with you. And our account managers are actually engaging currently to roll that out over the next 2 months.
Another question from Ronnie was, will the system also recommend helping to target profitable clients, in order to increase limits, not just where to reduce?
Yeah, so I think that was similar to that previous question, is that the solution provides you where we see a positive payment trend around trade data, either with yourselves, but obviously the industry data, there's no adverse data. We would recommend an increase in the credit limit for those clients. And that comes through under that to-do section where you can actually analyze which clients need to have or can have extended credit limits. And rather than doing it your annual review, or some companies do 6 months, you actually have a system there that's available 24/7 with live data, and you can go through client by client in your time at no extra cost. You're not paying for a report every time. It's one amount you pay per month for the solution, and you can use it as much as you want on your entire debtors book.
All right, I think that we've done a good job of these. There's a few outstanding. I'm sorry, we're not going to be able to get to all of them. But because most of them, I think we need to sit down and talk to you. They're very specific to your business. So please, if you don't mind, click on that link for the survey. Very, very quick. It will help us to understand how to do this better next time, but also which of you need more information, more assistance, where to from here. So the next steps are, please go to the chat, click on that link, fill out the quick survey, and we look forward to discussing and presenting and going through POCs with you on this. So we're really excited about this, and the next few months are going to be very telling. Our entire team is working incredibly hard to get this thing out there. I just want to thank everybody involved today again in the launch. Thank you, Ian. Thank you, Nikki. And thank you to the entire team behind this, and everybody in Inoxico has worked so hard over the last few months. Developers, data scientists, people in operations, the entire management team. It's been a huge effort. A lot of work still to come. I also want to thank our customers who've been working very closely with us on this. There's been a number of you who've given huge amounts of your time, making sure that we are on the right track and giving us really honest and helpful feedback. So to all of those, this is a huge team effort and will continue to be so over the next few months. We look forward to seeing more of you and spending more time with you. Thank you so much. Cheers.